Are you a real estate investor looking to sharpen your skills or a newbie looking to become one? You're in the right place. Welcome to Where Should I Invest? Real Estate Investing in Canada with your host, Sarah Larbi.
Hey guys, it is Sarah Larbi. I'm excited for another week with you, and I want to thank you for tuning in every week, listening to these podcasts. I would not do this if it wasn't for you reaching out and letting me know how much it has helped. And those are some of the greatest emails, the greatest comments I get when you write to me and you let me know how successful you are and how you've been able to accumulate wealth and reach your goals. So keep them coming. If you have a really awesome success story, please share it. It definitely is why I do all of these things, is to help others do what I was able to do and more, and do better, and get different perspectives. So I hope you guys enjoy the podcast. Don't forget, please leave a rating and review if you haven't yet. That would be awesome. So today's guest is Mark Loeffler. He's a realtor and a real estate investor, and we actually talk about how to BRRRR larger multifamily properties and how to find them, how to work with private money, VTBs, vendor takebacks, dealing with vacant units, and much more. So I hope you guys enjoy the podcast. Mark is a wealth of knowledge, super insightful, has tremendously grown his portfolio over the last few years. Very, very successful real estate investor. And he's also got his own YouTube show. So don't forget to check that out as well. I hope that you guys enjoy this podcast, and don't forget sarahlarbi.com. There's lots of great content that you can reach out to me and get. I think I still have my fundamentals checklist. So if you want to see how to analyze a market, go to sarahlarbi.com. You can grab that. That's free. And then just reach out to me and let me know about your success story. I would love to hear it. And until next week, guys, I hope you enjoy today's podcast. Mark, welcome to the show. How are you?
I'm doing great, Sarah. How are you?
Good. I'm excited to have you. Now you're in the hot seat. I was just on your show recently, and we've shifted it over. So now you're going to be sharing your story and your successes and your insights. So I'm excited to have you on. For those that may not know or may not have heard of who Mark Loeffler is, can you give us a 30,000 foot view of what it is that you are currently doing in real estate?
So what I'm currently doing, or who am I guess. So who am I? I've written 2 books, Rent to Own, obviously, and Fix and Flip for Canadian real estate investors. I own about 200 residential units right now. I am a real estate agent who I help people buy investment properties. I am partners with somebody on the residential side. We work Oakville, Burlington, Hamilton mainly, a little bit Toronto. What else? Father of 3. So yeah, just busy all around, I guess.
That sounds like a lot. It sounds like you've got many hats, and you've definitely been doing a great job at it, because I can tell you you've got definitely a presence. You've built your brand. You've built a great reputation. And somehow you can still manage to do it all and be a father of 3 kids, which is incredible.
Yeah.
How did you bridge? Go ahead.
I forgot. I mean, YouTube star as well. I mean, I have at least 1,100 subscribers as of right now. And I mean, if you're airing this in February, hopefully, knock on wood, I hopefully will be around 2,500 by then.
You guys go and subscribe to the channel. What's the channel called? Is it just your name?
The Mark Loeffler Experience.
Awesome. All right. Awesome.
And we post there 3 times a week.
Good. So let's just take a step back. So you've built, a great portfolio of 200 plus units. And how did you originally start in real estate, and why?
Yeah. So I was working originally I tried to buy my first rental property, I was going to live there and rent out the basement, or live in the basement, rent out upstairs. Like when I was like 20 years old, in the beaches, basically, or upper beaches in Toronto. And it was like $180,000 at that time. And I was like short $5,000, and I just couldn't make it work. And then, so I was always interested in that. I always saw that, like, I was like, I could live for free, make actually a little bit of money by renting to a couple friends' rooms and then renting the basement. And, that was it. And then I got a job at Canon after traveling around a bit. And I read Rich Dad Poor Dad. Then I started buying duplexes in Newmarket and a couple in Toronto in the Junction area. And we basically went from there.
That's awesome. Canon, the hygiene company, or the photocopiers?
Photocopier.
I started at Xerox. Maybe
there's
something to be said, because I think, and Robert Kiyosaki, Rich Dad Poor Dad, started at Xerox too.
I did papers and paper accessories like The Office, like toner, paper, consumables.
Nice. So you obviously, read that book, and then you just decided that this life was not for you potentially, and you wanted something better.
Yeah, I mean, that was it. I figured there was not a better way, but a different way to be able to earn income and, and leverage, right? Leverage other people's time, leverage other people, get paid while you sleep.
That's exactly why I love real estate. So you've scaled. Now, how long ago was that you started?
So it's been 17 years since I started investing in real estate.
All right. So 17 years. I mean, that's 200 plus units or doors?
Doors.
Okay.
Units. Oh, no. So I mean, I don't own any student rentals or anything like that. So every door is a unit for me.
Okay. So and what is the strategy that you have utilized to be able to scale? Is it, the buy and hold? Is it the BRRRR strategy? Like, what is that strategy?
So I've done pretty much everything. 17 years ago, we were buying shitty properties that we would fix up, and then we weren't BRRRRing them as quick just because of how the financing was working or how I was using financing back then. Like I was doing 5% down owner occupied with like 3.5 or 4.5% cash back, so I could have money to renovate the properties. So to break the mortgage just didn't make sense. But at the end of 5 years, obviously I could refinance and do all that type of stuff. So it wasn't a quick BRRRR, yet I wasn't putting a lot of money in. So, I mean, it was fine. So I was doing that. And then obviously we started joint venturing on stuff like that. But we got into rent to own. We did, hundreds of rent to owns. I used to do flips. And then I finally settled on that, BRRRR is the best strategy out there. And so that's all I do now is BRRRRs, and I do them on typically multi-unit buildings. And 12, 15, 20 unit plus, and that's the goal.
That's good. So you've, I love the BRRRR strategy, and like it's helped me scale as well. You do it on even a bigger scale, and you can do a great job, increasing the net operating income, and maybe even less renos on a larger multifamily. But walk us through maybe the differences between BRRRRing a 4 unit and under property versus 5 or more that's considered commercial residential.
Yeah, so 4 and under, obviously it's residential. Two biggest differences are that 4 and under you can do a lot quicker. I mean, you can do in 6 to 18 months and be done, totally done, refinance, get the highest and most value out of it. Yet one of the downfalls is you have to qualify, obviously, for mortgages. You have to have income. Bank doesn't like us retired folks who don't have a steady income. So they're harder to finance.
Square box.
Right. Whereas in commercial, I do 2-year increments, and so I break it up, and basically in the first 2 years, I turn over as many units as I can. I refinance at 2 years. Some buildings I get out all my money. Some buildings I don't. But the goal is within 4 years to have all the money back. All of our initial investment plus any rentals we've put in so far.
Okay, so 2 years, and then 2 years, then 4 years as the max to be able to turn those units over. So when you do look at a property, I mean, do you look at, okay, I'm going to have to take each unit one at a time and renovate it? Like what is your overall plan when you're looking at BRRRRing a property or a multifamily at this point?
Yeah, I mean, I honestly, I would like to do about 25% in that first year, have 40% done by 2 years, and then by year 4, it's 60 to 75%.
Okay, so essentially you'll take a unit and you'll renovate that unit, you'll command higher rents, and you'll try to do that with enough units that you can get the lift. And then based on the net operating income and the cap rate, you go back to the bank and you say, here's my new income. And based on the cap rate, I qualify for X, that, thousands more for to be able to refi. Is that correct?
It's big enough. It's millions more. Yes.
Okay, cool. So can you walk us through like an example of like a recent one that you've done, like where you found it? Was it on market, off market, and like maybe just like overall financials?
Sure. I mean, you can all just go to my YouTube channel. I post all my numbers there. I mean, you can watch those ones. But I did a 30 unit beginning of COVID. I have to look up the numbers. I don't really remember them. Yeah, actually, let me just go look them up here.
No worries. And it doesn't have to be like exact. I mean, it could just be approximate. Like if you bought it for like 2 mil, you put in like.
So I mean, I bought it for just over $4 million. I do have it here, so.
That's fine. We can edit all this part out. That's the beauty.
Yeah, I know. I'm not worried. What are we doing? 20 Duke. So I had like 4,050,000. Gross rents were like 21,000 at the time, which is obviously about $700 a unit. We think we can get $1,100 to $1,200 per unit there. They're mainly bachelors. So we closed on it. So we bought it before COVID happened, but our due diligence period was during COVID. And so I think our original purchase price was 4.2, and then we got it down to 4,050,000 because we didn't know what was going on with COVID. And, obviously the banks were doing funny things back then. They weren't really saying, hey, we'll lend. So we basically bought it cash with a VTB. And so since then we closed in July. What are we now? In October. So 3 months. We have 12 units vacant in there right now. We've also had a retaining wall collapse, and that's a $100,000 bill. And we've put in new boiler system, which was another $60,000. We have 3 work orders from the city right now because when we put the new boiler in, a couple of units flooded, which again helped us get some people out yet. So at the end of the day, I think in a year we're going to pull out all our money and the rental costs for the additional. I think we'll have half the building basically done by then, and we'll be able to pull out all of our money plus a profit plus the renovation cost for everything on that.
Yeah, that's awesome. I mean, obviously the wall and the $100,000 repair that you may not have foreseen is, it's one of those things, right? You go into the bigger multis, there's going to be bigger problems, or there's also potentially going to be bigger rewards at the end of the day too.
Well, that's right. Again, we bought it for $4 million. If we get the rent roll to let's add, $500 a unit on 15 units. So an extra $7,500 per month. So now we're at like $29,000 per month. That's right there is adding almost $100,000, like $90,000 in income per year. And that's all profit. Like my expenses do go up a little bit, but not much compared to that. So let's say $70,000 that is profit, at a 20-time multiplier, and cap rates have done us a favor because interest rates are super low. Like on a CMHC loan, I'm getting 1.2 to 1.3% on a 5-year right now. Nice. So that's compressed cap rates even lower. So on refinances, they're now refinancing me at like 4.25 instead of 4.75, which then just increases my value even more.
Yeah, and the lower the cap rate, the better it is, right? In terms of pushing the value of your property up on refi. So you don't want like an appraiser to come and be like, I'm gonna, use a 5 cap versus a 4 cap, because your valuation is going to be, and maybe you can talk on that a little bit, but your valuation is going to be better on the lower cap
or, when you're purchasing a property, also make sure that you know the area cap too. But talk us
Right.
about your insights on that.
So when I buy a property, I want the highest cap possible. I want to buy a 7. Everybody wants to buy at a 7, right? Or 9 or 10 or whatever. And when I refinance, I want it to be financed at a 3 cap, of course. And yeah, it's just a matter of, how they're looking at value. And, I'm typically buying right now at like 3.25 to 3.75, and that's been compressed even. Like we just saw a deal happen at 2.75 at a really good area, Hamilton. Yet again, I want the lowest cap rate possible. And if you guys want, like, go to my channel. I did a talk on how commercial financing works. It's a good 25-minute video, so go check that out.
It is completely different, right? And sometimes, like, you don't even need to really rent it. Like if you buy something and the rents are lower and, over time as your tenants turn over, you put a new tenant in for $500 more and you do that over time, you may not have to do a whole gut job, right? Or it's not, you can have a 10-plex and another 10-plex across the street from each other, and they could be completely different in price because of the net operating income. So, keep that piece in mind. Now, when you're looking for properties, are these on market or off market?
Right. So the best deal I ever got was on market.
Oh yeah.
And like that was a 22 unit, and I think it was the last actually concrete construction building in Hamilton that sold for less than $100,000 a unit. I think we bought it for like $98,000 a unit. Nice. And now it's over 200 a unit for sure. So, that was on market. I bought a couple on market. I bought a couple off market. Typically, they're all through real estate agents. So the 30 unit I bought was not, through a real estate agent. It was through somebody I knew. So networking, whatever. But most of it is on market or through a listing agent that, they don't put it on market, but it is marketed. It is a marketed property.
Right. So those that are, in that market that have purchased already, that have been networking, you'll get listings rather than having them go on MLS. Like a lot of realtors will probably go to their top investors and say, are you interested in this property?
Yeah, right? For sure. But yeah, for sure. If they know you can close, they know that you're willing to pay a decent price, it's just easier. And, the other thing is like putting it on MLS, you just get, you get a lot of tire kickers and that type of stuff. It's just a waste of time a lot of times. If you have a good database, you can market to your database. And, there was a 12 unit and they had 5 offers on it. They listed at 1.9 something. And I don't know what it sold for, but it probably sold close to 2.3.
Well, so if somebody is interested in finding some, potential connections or deals that way, like what are some like strategies or tips that you can give them to how to get, their foot into that, those connections?
Yeah. Talk to a guy like me. Okay. Be serious. There's a whole bunch of people that come and they talk to me about this type of stuff, and you can just tell they haven't done their homework. They haven't talked to, they don't know what they're going to do for financing. They don't know that on obviously commercial, it's probably going to be 35, maybe 40% down. You're going to be lucky if you're less than that. And they haven't talked to anybody about that, right? They don't know. They haven't set that all up. They haven't, for me, I send my net worth statement in every 6 months to my broker because I'm constantly doing things, right? I'm constantly just working that. So it's like, okay, 6 months, here's my net worth statements, here's all this type of stuff. They don't really care about my income. It's more about my net worth, right?
Yeah, absolutely. For commercial, residential, and commercial property. So how are you doing, you were talking about your broker, how are you doing the financing? Is this coming from just because you've been in the market for 17 years and you've been building it? Is this your cash, or do you work with investors? How are you doing the financing piece?
So I don't put any of my own money in on any of these real estate deals. I mean, I can't remember the last time I actually put money into, actually, no, I do remember the last time I put money in. I bought a 19 unit property and I got lazy. I found one investor. It wasn't enough. And I was like, well, it's only a couple $100,000 extra. I'll just throw that in there and take some of the equity out of that, right? Just because I just couldn't, I couldn't be bothered to go make another phone call or two. But since then, and that was probably 6 years ago, I don't think I haven't put any more money into a real estate deal. It's all been joint venture money. And with that, basically we're financing through A banks. We do 98% of our financing through BMO right now. And we're just, we always look at other solutions. It's just that we have such a good relationship with them right now. And the more you do, the higher they bump you up in the level, and they keep, the fees they waive fees for us. They do a whole bunch of stuff. So it's like, well, it's just easier to stay with them at this point, right? Like,
Yeah. So you mentioned BMO, like, there's probably, a few different banks that as a residential investor, you may not necessarily go to as your first ones, but there might be some banks that are going to be better from a commercial standpoint than others, right? And you mentioned BMO as, as one of them.
Yeah. And we've done a couple deals with credit unions right off anything that I used to buy real crap holes. Basically we gutted them. Like the 19 unit we bought for $950,000, we spent $1.1 million renovating it. So we bring in a credit union, they would, finance us, and they'd finance the construction for us as well. Whereas I'm buying better buildings now, so I really don't need that. They basically come in, they provide financing, we fund our construction when units come available, and that's basically what we do.
That's interesting. So you get, the construction funds and the construction loan is probably a lot more expensive than the bank financing the property itself. Like what do you know what the rates are? And I know you're not a mortgage broker, but like roughly like on a construction loan from a credit union.
So we were prime +3 interest only. So I think at that point we were 5.5. Okay. So it wasn't that expensive. I was very happy with the construction loan and everything. And to be honest with you, I would have loved to work with them on a takeout, yet they just couldn't get the value to where we needed it.
Right. Now, do you go to CMHC on the refi once you're done, or do you not consider them?
I can't say never. I did one CMHC loan on a takeout. I find them painful and extremely difficult to deal with. And they just take so long. Whereas I can just call up my BMO person and just say, hey, this is what's going to happen. Here's our timeline. Does that work? And typically 6 to 8 weeks later, I have money in the bank. Whereas CMHC might be 6 to 8 months.
Right. Yeah. No. Definitely, they're backed up and they're slower than unfortunately than we were hoping for. So you mentioned also VTBs and doing it with this last deal that you were doing through COVID. Is that a one-off, or is that also a way that you get some financing upfront?
It's not that common for us. This is the first time since the first apartment building that we've had it. During COVID, I did negotiate 3 VTBs, and this was the only one we actually used. Because basically in the middle of COVID, banks were like, hey, we're not doing anything. And then July, August rolled around. They're like, hey, we're okay. Like, we're not swamped as we were with the small business stuff and all that type of stuff. Yeah, we want to loan you money now. So basically we had a deal close in September for a client. He had a VTB and he said, nah, I don't want it. Let's just take it off the deal, right? Yet when we meet some of these gentlemen or people who own these properties, a lot of them have no plan for what they're going to do with the lump sum payment. So we offer them, to hold a first mortgage, so we can still provide them income every month, and they can do different tax planning because maybe they don't have, because if they do a VTB, they can spread their tax over 5 years, right? So that's really more what we're seeing rather than, using a second mortgage or something like that. to be able to fund the deal.
Right. Okay. All right. And then your investors that are going to be in the deal will usually fund the down payment and the reno costs, potentially even if there's a VTB in first position.
Yeah, for sure. Yeah, I mean, we only use a VTB in first position. Like we would go for 75 to 80% of the purchase price and try to negotiate 3.5 to 4% interest only mortgage type thing, right?
Yeah.
It just gives us, it usually lets us cash flow for the first year or two, then we can refinance that out and pull in a different mortgage.
Yeah, I mean, and it's in a way it's a win-win because they may be able to, and I think that there's going to be an opportunity. I don't know, and you can feel free to let me know your thoughts. But I think there's going to be an opportunity should the market start like slowing down, and who knows what the aftermath of what the economy is going to look like with everything that's happening. I don't think it's sustainable to have all these like multiple offers on everything. Personally, I think it's going to slow down, but could there be an opportunity for some additional VTBs that, maybe somebody wants to sell, but they may not get the price that they want? Well, maybe they're willing to do a VTB at 80% loan to value at something affordable that you can, work on the property for that 2 to 5 year time frame. And in the end, they can get the price that they wanted to. That is probably not going to sell in the regular market. I don't know. That's my take, but feel free to, challenge it or whatnot.
Well, so it depends on what market we're talking about, obviously, right? If we're talking downtown condo market, I mean, when you hear this in January or February, I mean, this is October right now, and we're starting to see a spike in listings and not the spike in sales. So things are sitting on the market longer. Prices did go up in September, even on condos. I think you're going to see, well, one of two things is going to happen. Some of those are going to rent out. It's a lot of micro condos, so stuff that's under 500 units in downtown Toronto. So some of those are going to rent out. People are going to start moving back to the downtown core. Yet that's going to probably take 12 to 18 to 24 months. And then number two is, you're going to start to see some depression in prices there. And we're starting, even in Toronto, we're starting to see a little less activity out there on some of these properties. As for apartment buildings, here's the thing. I mean, if interest rates remain stupid low, which I think they will, because I don't think the government can really change that. I mean, you're buying them at a percentage between what that is and the cap rate. That's your margin, and you're looking at these things, and if I'm buying an apartment building in Hamilton, I mean, I'm overpaying today for what it's actually giving me. Yet the opportunity is that I can take that from $700 a month to $1,200 a month rent. And I don't see rent like going down. At the end of the day, like Hamilton needs 1,000 units per year just to stay, like rental units per year, just to stay even keel. And they haven't gotten that in, I don't know, forever, right? Yeah. So I think
location depends on the type of property. That makes sense.
Yeah. And obviously people are moving out of the downtown core, right? Yeah. And yet people are still hiring. Now, if we get a phase, like obviously we're going back into phase 2, which I think is, I mean, personally owning 3 restaurants as well, I think is ridiculous. Doug, don't do it. And if you're watching this after, Doug, don't do it.
So I'm going to ask you a question that's like, a little bit off the cusp of what we were discussing, but what are the restaurants called?
So Caro, which is at James and Ottawa, Ottawa on Main Street, and then Caro on James, which is James Street North, and then Victoria Steakhouse, which is at Locke and King Street.
So how have you guys been, maneuvering through, I guess, everything that happened since March?
Right. So it's funny. So Caro was our original restaurant. It's in that 19-unit building that I bought for $950,000, put $1.1 million in. That's how I got into the restaurant business. Was a guy I met, wanted to open a restaurant, didn't have the money to renovate. We were renovating anyway. So I said, hey, we'll do it for you, but we want a piece of the business. And that, started it. Now we have 3 restaurants together. So Caro did well, so they did pick up and delivery. That's very neighborhood, like they do great they do great things in the neighborhood. So all the neighborhood wanted to support. And, you know, at that time you were like, well, where else am I going to spend money? I'll go grab a couple pizzas, grab a bottle of wine from them, whatever. So Victoria's, the steakhouse, had opened 2 weeks before COVID started, and they didn't really have that, you know, cachet, I guess. And the other thing is it's a steakhouse, right? So it's like not so good for deliveries.
Right.
So they basically just shut down, and they were down for 124 days before they reopened. And then we just opened a third restaurant like a week and a half ago during COVID, during the pandemic. You know, we got a good deal on some rent from a restaurant that went under. So, yeah.
So, I mean, that is interesting. And I mean, you just started these restaurants and you know, a lot of in the midst of everything that was going on. So, you know, would you recommend that somebody get in the restaurant business right now, or look at commercial property at this point? Like commercial, not residential.
Commercial retail. So would I recommend people get in the restaurant industry? Never. No, I don't know. Like, here's the thing. Like, my partner is a good operator, right? I'm the passive investor on this. I'm the silent guy, you know, and that's just me diversifying away from real estate a little bit, because a lot of my assets are in real estate. So, and if you're going to buy retail, I mean, if you're buying retail in good locations, there may be 6 months of pain there. Yet I think, you know, in that, you know, 6 to 12 month period, yeah, you're going to do okay. And it's funny, like I was looking at a Plaza the other day, and I'm looking at the mix in there, and there's a grocery store and a liquor store, barber shop, couple like fast, like takeout places type thing. And like the only one I could really see that I would think would be an issue is the gym, because if, you know, they get shut down again, that gym gets shut down, who knows what they're going to do, right? The rest of them, like, that's what we discovered, like during the first COVID. Damn, we need barbers, right? Like I needed one, like it was getting bad, and I even waited 2 more weeks, for no reason other than I was lazy, and I was like, I'd, you know, getting the fro going on.
Yeah, I mean, and you mentioned a really interesting point. You've got to, if you are going to get into this industry and go into retail, and you're looking at plazas, because I mean, it's something that we don't talk a lot about on this podcast, but you know, to look at the mix and look at, is it recession proof, and what happened to them during COVID. But I mean, it's a whole other ballgame, a whole other, you know, discussion to have at some point in the future. But it's definitely something interesting. You don't want to be buying something that, you know, where there's everything that shut down, and they're still shut down, and you know, so weigh your pros and cons. But could be an interesting opportunity, you know, in 6 months from now or 12 months from now to maybe scoop some things at a, you know, potential discount. I don't know.
Maybe. I mean, I have a friend who owns a lot of like commercial properties, and in March he was like, okay, back the dump truck up, let's buy a whole bunch of stuff cheap. And he put like, I don't know, 20, 23 offers in. He got 2 accepted, closed 1 deal. And it was really that first 2 weeks. And now everybody's like, no, just hold on.
Yeah,
I'll be fine. They're like, if I don't get if I want to sell, I want this price. Right. And if not, then don't worry about it. I'll be fine.
It is interesting. I mean, like, would you have imagined that, I mean, even just going back to residential, like the market would be this hot with multiple offers on everything? Like, you know, back in March, do you think?
So you should have watched one of my videos. One of my first videos I ever did on my channel. I'm like, this is a buying opportunity. This is like 2008, 2009, when, you know, there was that. So that was a 6-month period where you could get a great deal. And I was like, you know, I think that, you know, we're going to see, you know, I thought maybe a couple months that you could buy. Yeah. At the end of the day, there ended up being 2 weeks, maybe 3 weeks, where if you bought during that period, you were up 20% by June. And I thought, my thinking is like, okay, everybody's panicking, yet who's losing the jobs, right? It's retail, it's hospitality, it's lower income people who aren't buying houses anyways, right? They're not buying income properties. They're our tenants. And CERB, I mean, did its job. I mean, I collected majority of my rents all through that. And, everybody else like still had a job, right? It wasn't full-time people getting laid off or anything like that. There were some, yet the majority of people still had a job. So they were looking around saying, well, I'm still working from home. I'm still getting paid. Why not, go out and buy real estate? And then by April, they, had woken up and said, oh, and then prices started to shoot up again.
Yeah, it is interesting. I mean, nobody has a crystal ball for the future, but at the end of the day, like there's an opportunity in every single market, right? You gotta find it, and some is easier to find than others.
Well, I call it the crisis-tunity.
I like
there's always opportunity in a crisis, right?
Yeah, absolutely. Awesome. I mean, we can keep talking, but the next part of the podcast is going to be our lightning round. So Mark, I'm going to ask you a series of 5 questions. You can give me the first answer that comes to mind. Are you ready?
Yep.
All right. Question number 1, what is your favorite real estate investing book?
Rich Dad, Poor Dad.
All right. Number 2, if you are a podcast listener, and this could also be a YouTube show, other than yours or mine, what is your favorite one?
So other than the Mark Loeffler experience, Matt McKeever.
Okay, awesome. Question number 3, what do you do for fun aside from real estate or working on anything related to real estate?
Golf and put myself through horrible physical endurance activities.
All right, like what?
I ran 100 kilometers a couple weeks ago. Good. Just for fun.
Nice. You're on your own on that one. I do Orange Theory Fitness, and that's good. That's my workout for the day.
There you go.
Number 4, if you lost all of your money and your assets tomorrow, how would you start again?
Again, I would just go and buy more real estate, and I would just, I'd start in 2 to 4 units, and I would just start doing BRRRRs. And I obviously, if I lose the money, but not the knowledge, I would just build that up, and it would be pretty easy to do, I think.
All right, awesome. And last question, if somebody has $50,000 and they want to get started, how would you recommend they spend that money?
How would you spend $50,000? Go get educated. Spend at least $10,000 on education. If you're going to do real estate, take that education and turn that into figuring out how to joint venture with people. So you have to use none of your own money. And then I would put like another $10,000 or $20,000 into options trading. And I would start learning how to trade options.
All right. Okay. Mark, where can my listeners reach out if they wanted to know more, find out more about you, or connect with you?
Yeah. Mark Loeffler Experience on YouTube. Has all my links for all my social media there, but living the dream 40 on Instagram as well.
All right, awesome. Any final last words of advice before we go?
I think so. 2 things: the best time to buy real estate was 50 years ago. Second best time is today. And my personal mantra when I'm buying apartment buildings or anything right now is, yeah, I know I'm overpaying, yet in 5 years I'll look like a genius.
Yeah, that's a great point. Awesome, Mark. Thank you so much for being on the show.
All right. Thanks, Sarah.
Thanks so much for listening to Where Should I Invest with your host, Sarah Larby. Make sure to listen in next time. We'll catch you on the next episode of Where Should I Invest?